Markets getting off to a strong start to the week with all three major indices closing in the green. The Dow at more than 400 points is now up 10% from the lows of the month. The move comes even as Treasury yields continue to climb higher. The two-year yield back above 4.5% today. What do we make of this rally, Dan?
Well, listen, we've talked about this a little bit. We thought, and I think we all agreed about a month ago, that there was a really good chance that Fed whisperer at the Wall Street Journal was going to float some article a week before the Fed meeting, and he did, about like the idea that the Fed might pause for their fourth consecutive 75 basis point hike when they do it, and maybe they pause, or like at least take the foot off the pedal a little bit. Also, the comparison, and Guy's been making this very aptly, you know, from that mid-June meeting, that rally that we had into mid-August, what was it predicated on? Well, sentiment got really bad as far as the stock market was concerned.
Right.
And we knew that estimates were coming down into Q2 earnings. When they came out, they weren't as bad as expected. Sure, there was some one-off things. So we just kept on rallying until the realization, though, in August is like, no, things are not particularly good, only getting worse, and visibility is horrible, no matter what the Fed does. So to me, I think we could be setting up for that. We rallied 18% from those mid-June lows to the mid-August highs. We're about 8% higher right now. Guy, what do you think? 4,100 or something like that? You know, that would be like 15, 16% off those.
And the vitriol on Twitter on the back of that is significant. I mean, I'm not bullish. If anything from these levels to 4,100, in yes, I guess in the short term, that's bullish. But long term, none of the problems that we've been talking about for a year now have been fixed by any stretch. But the biggest rallies take place in bear markets. And like it or not, we are in a bear market.
I mean, a 50 instead of a 75 in December, that's not going to solve any of the worries, right? Alleviate any of the worries that anybody had. Turning now to the big news across the pond, Rishi Sunak is set to be the next Prime Minister of the UK. The news sending the UK gilts rallying this morning, but they've since given up gains. For more on this and the broader market, let's bring in Jim Bianco. He's the president and macro strategist at Bianco Research. Jim, great to have you with us. I feel like the comments that we were just making sort of applies to the situation as well, in that you know, people may be relieved that an ex-finance guy, an ex-finance secretary is now the prime minister, but the problems that the country faces, the UK that is, are still there, and they're still very deep. They're not fixed at all.
Oh, that's right. Just because he knows how to use Excel, and there's some Twitter feeds of him doing exactly that, doesn't mean that the budget problems are going to be fixed in the UK. They still have a fundamental problem of high inflation, low growth, big bills coming for energy, and how they're going to try and solve that, because they've promised that there would be a subsidy for all of that energy cost that everybody's going to bear this winter. And the mini budget that Prime Minister Truss put out failed, so now we're back to square one. How are you going to fix these problems? And we'll see what he comes up with.
Yeah, it sounds like, and I don't mean to force a trading cap on you, Jim, but any gains that were made off the back of this news or going into this news should be short-lived.
I think that that's right. Also, remember that the UK gilts market, the Bank of England has 230 years of data on it. Now, the reason I bring that up is what we've seen in the last 3 or 4 weeks stands out in 230 years of data. We've not seen this kind of volatility in this market. Today was a quiet day. It fell 30 basis points. Any other time, that would have been a holy cow kind of moment for this market. But now it's just Monday is the way it's been going. And that doesn't mean because it fell in yield as opposed to rose 30 basis points that somehow the problem is fixed. It's just as dysfunctional when you see falls in yield that much as you do see in rise in yields. So the message the market is saying is, we're not healthy. We're not getting better yet. We still need to see what your budget's going to be. Are you going to require a massive amount of borrowing? And that remains to be seen.
Hey, Jim, it's Jeff Mills. So I just want to switch gears a little bit and talk about rates here in the U.S. You know, I keep waiting for longer-term yields to peak, you know, that gravitational pull from slower economic growth, presumably an impending recession. You know, long-term rates tend to fall in those environments. So do you see that happening this time around? And what do you think it's going to take for that long end to stop rising?
Well, first of all, let's put this in context. The long end, the 10-year yield, is up 12 consecutive weeks. We've got data going back to 1941. This ties the all-time record with 1984 and 1956. The yield rise, weekly yield rise, started in July, late July, and the stock market, the S&P, is down 11% over the same period. There's been no indication that this yield rise is going to stop, and that's because it's a situation where good news is bad news. as we continue to see the fall in the unemployment claims, as we continue to see strong economic numbers, as we continue to see decent earnings, the bond market keeps concluding, okay, we can go higher, and we can go higher, and we can go higher. So ultimately, I think it's going to take something like some bad economic data, a plunge in the market, or something to stop this rise in yields. Because it's been extraordinary. Like I said, it was actually July 29th is the last week that we saw yields fall from Monday through Friday.
A 9-week streak of higher 10-year yields going back into the 1987 crash. You don't just lightly, Jim, toss in the mention of the 1987 crash in some notes unless you're trying to actually make some kind of point, are you?
Yeah, if you look back, we're in week 12. If you look back at every time the 10-year yield has been up 9 consecutive weeks or more, has been a terrible time to own stocks. You've lost money in every single one of those, except for one in 1979, when you made a little bit of money in a 14% inflation environment. So on a real basis, you still lost money. And that includes the 1987 crash. In other words, what it says is the stock market can't handle rates keep going higher.
Right.
They either need the Fed to pivot and tell Dan that the proper term is step down from 75 to 50. Now he could be a official Fed watcher now that he knows that term. And that they either need that or something else like bad economic data or the stock market to stop this yield rise. Otherwise, it's just not going to stop.
Right. Jim, thank you. Good to see you. Jim Bianco. Jeff Mills, what are your thoughts about that neat little stat? I know you like numbers, you like data, but there's a difference in terms of the rise where we were and where we are now versus those other periods where we started from a much higher base and went to, in some cases, double digits in terms of interest rates.
That's true, but I think it's so easy to try to outsmart ourselves here, and I think we just need to keep it very simple. Guy sort of alluded to it that nothing has changed that much. Inflation is too high, the labor market is too tight. The Fed is going to keep tightening, so rates are rising. The curve is inverted. We got PMI data today in the U.S. that looked horrible. Both services and manufacturing were in contraction territory. We're still in a downtrend in the S&P 500. I think less than a quarter of stocks are above their 200-day moving average. So listen, we will get bear market rallies. That is the rule, not the exception. But none of these really critical elements have changed. So keep it simple, and I think that's going to be the driving force here.